why the good news in home sales is bad news. For the first time in a year or so, the housing market is picking up a little. Home sales that had come to a halt are starting up with the benefit of what look like fire sale prices. And yes, a few bargain hunters have stepped up and put a small dent in the housing glut. But the slow cycle of foreclosure sales and falling prices will continue to wreak havoc as it works its way through the economy. In Southern California in September, the number of homes sold jumped by close to 2/3 from a year earlier. In the great foreclosure belt around Los Angeles, places like San Bernardino and Riverside counties, the jump was even bigger, with houses selling at twice the pace of a year ago. Of course, that's only for 1 month. At any other time, this would be welcomed as good news, but not in these times. Buyers are back, except that it's clear that this wave is driven by lenders trying to get anything they can right now for the many thousands and thousands of homes they foreclosed on, because as bad as the housing market looks now, it's going to get even worse. Unfortunately, we have a lot further to go. The Case-Shiller Price Index, a measure of home prices going back to 1987, shows that California home prices still at about twice where they were at the peak of the last big housing cycle back in 1990. So, just to get back to the top of the last peak, prices would have to drop at least another 50%. Interest rates at that time were substantially higher though, in the range of 10%. If you take that into account and look not at sales prices, but at the cost of paying mortgages, it could still be in for a drop of at least 30%. And here's the story. That's if prices don't fall below the last peak and interest rates stay at 6.5% or less. In other words, it's a best case scenario. It could be much worse than that. Perhaps the price of homes have been way too high. Yes, they were pushed up way too high, more than what people earn. They haven't kept up with the wages, have they? Home prices keep falling. Home values plunged at a record pace in August, according to a prominent housing index. The pain is most acute in the Sun Belt. Elsewhere, there are some signs of stability. These numbers are so dire that they might sound like scaremongering, except that if you look for the recent sales listings at any number of online sites, you won't have to search very hard to find price drops right along the lines of these numbers. For instance, a house in Riverside, California was bought for $586,000 in 2006, foreclosed on in November 2007, and sold this last summer for $147,000, just 25% of what it sold for just 2 years ago. And here's another fact. Even that vastly diminished sales price was financed, according to real estate records, with a 100% mortgage. It would be very hard to get one of those now. Incomes are still way out of line with home prices. What this means for homeowners is that if you happen to buy at the peak of the boom, your house is unlikely in inflation-adjusted terms to ever get back to the price you paid for it. Even another decade. Doesn't matter when, the prices will keep falling. You may think that this goes just for the most inflated markets, like the real estate speculation capitals of California and Florida, but that's not true. Look at the historical numbers, and you'll see that just about any coastal market is still priced 75% higher than it was in 2000. And yes, once again, what's this all about? Greed. Yes, greed. And even markets like Charlotte, North Carolina, and Cleveland have real estate prices twice and sometimes three times where they stood at the end of the late 80s boom. So the bottom line is that incomes just haven't risen enough to support this kind of increase. Just a few days ago, Alan Greenspan, the pope of the economic boom, confessed that he had no idea that home prices would crash the way they have because, well, it has never happened before. Clearly, quite clearly, we're past the point now at which anybody believes that. But the prevailing wisdom remains if you hold on to your house for a long time, eventually you could make some money. But now, these are different times. These are not normal times. Not at all. So don't count on that. Yes, markets can come back, but a bubble is an irrational rise in prices, and once the balloon is popped, it doesn't magically inflate again. The consequence for anybody who owns a home is that the reigning turn of the millennium assumption that you could count on your house not only maintaining its value, but providing a nice cushion that you could cash out for a comfortable retirement is no longer in effect. And over the long run, well, it could have some good effects. But people would have to start actually saving money. And as we see, our extremely low savings rate is very low. But over the short run, it will have terrible effects as the cycle of foreclosure sales and falling prices works its way through the system of the economy. Some policymakers have worried that a bailout of homeowners could encourage people who can afford their mortgages to go into foreclosure and take advantage of generous bailout terms. But they don't have to worry. Homeowners already have incentives to walk away from their upside-down mortgages, a lot bigger than any bailout would give them. Nearly 1 in 6 homeowners owe more for their house than the home is actually worth. What good is that? The relentless slide in home prices has left nearly 1 in 6 U.S. homeowners owing more on a mortgage than the home is worth. Of course, a lot of people took out second mortgages or more, raising the possibility of a rise in defaults. The very misfortune that touched off the credit crisis last year. Yes, there's a lot more to go. The result of homeowners being underwater is more pressure on an economy that is already in a downturn, a recession. No longer having equity in their homes makes people feel less rich, and thus less inclined to spend money. So, is fear the cause of the financial crisis? Panic, greed, and having more homeowners underwater is likely to mean more eventual foreclosures because it is very hard for a borrower in financial trouble to refinance or sell a home and pay off the mortgage if the debt exceeds the home's value. A foreclosed home in turn tends to lower the value of other homes around it in its neighborhood. Approximately 75.5 million U.S. households own the homes they live in. After a housing slump that has pushed values down some 30% in some areas, roughly 12 million households, or 16%, and rising, owe more than their homes are even worth, according to Moody's Economy.com. The comparable figures were roughly 4% of homeowners in 2006 and 6% last year, says the firm's chief economist, who adds that it is very possible that there will ultimately be more homeowners underwater in this period than at any time in our history. There are many more people that are going to find out that their homes are not as worth as much as their mortgage is. That means more people will walk away. More foreclosures. More lost jobs. A worsening economy. The spiral effect, or you could call it the ripple effect. Most homeowners still have some equity, and even among those who don't, well, There's more to come on all this, and these are more signs of the end times transition days, and there are many signs.